I'm delighted that we got responses to calls to paper last first. Of course, I then took Denny and I said, look, you're responsible for this, so you've got to come and help us out. But in the call for papers, we did succeed in getting Dr. Ramzi Rosman, who's going to write about IFRS or Al-Wifi, that is the Islamic financial accounting standards for Islamic financial transaction evidence from Malaysia. So he'll tell us the story of Malaysia. Ramzi is an assistant professor at the Islamic University of Malaysia, specializing in Islamic finance. He graduated with a BA in Honours Accounting and Finance from the Lancaster University, UK in the year 2000. He was awarded an MBA in 2005 and a PhD in Islamic Banking and Finance in 2012 from the International Islamic University, Malaysia. He's published research in several referee journals, and anyway, he's with us. Our second speaker, I was able to get somebody from Indonesia to give us what's happening there, is Dodik Siswantoro, who is going to look specifically at sukuk accounting in Indonesia. Actually, he wrote originally a paper about everything, and I thought, well, it'd be better just to focus on one thing. It's confusing enough. So anyway, he's going to be talking about the influence of fair values, IFRS, to sukuk accounting standard in Indonesia. Now, Dodik is a lecturer at the University of Indonesia. He graduated with a Master of Science in Accounting from the International Islamic University Malaysia in 2003. His major research topic is on Islamic accounting and investment and the public sector. Many of his papers in this area have been published in top journals, and of course we hope to get him to get something that's nice and publishable for our book as well. Anyway, without any further ado, Denny, I should also, I guess, further introduce. He is the director in the Accounting Advisory Service line of business of KPMG, where he provides advice to both conventional and Islamic financial institutions in areas such as accounting conversion, hedging transactions, we have those in Islamic finance too, lease structuring, and other related topics. Denny is also a key technical topic team specialist in KPMG on new development of accounting standards, in particular on addressing how they impact different industries. Denny has worked extensively on accounting conversions and adoptions in various countries such as the US, Japan, Singapore, Malaysia, and Indonesia, and Brunei. Yeah. So he's going to talk about the incompatibilities. Basically subtitle square pegs and round holes. So without any further ado, Ramzi, we'd like you to give us the lowdown from Malaysia.
Thank you very much, Mr. Chairperson, Professor Clement. Assalamualaikum and good afternoon. Okay, basically, I will present a joint author, a paper. Okay, the title of this paper is IFRS or Al-Fi for Islamic Financial Transactions, Evidence in Malaysia. So basically, okay, I'm with these other two experts, so I will make the introduction as usual. Okay, so and then inshallah the others will continue on elaborating some of the issues. Okay, basically this paper is a qualitative analysis. Okay, basically what I did is I gathered issues in accounting for Islamic financial transactions, and I tried to interview an experts. Okay, frankly, I still need to interview few more participants. Okay, so for introductions, the reporting of Islamic financial transaction is unresolved challenge. It's been discussed since 2000 by academicians, okay, especially in the issue of Islamic accounting. Even if we talk whether there is an there is a word Islamic accounting, some people may argue. Okay, usually from my discussion, the practitioners don't really like to say Islamic accountings. But if we look at, let's say from academician point of view, some of it, they put it as Islamic accountings. They have a syllabus called Islamic accounting, they have a books called Islamic accountings. So, I still remember when I did my master's, 2005, okay, I learned accounting for Islamic financial institutions. During that times, I learned with the AUFI books. Okay, AUFI books. Okay, because why they choose AUFI, the books? Okay, because AUFI is the only, okay, accounting, that have produced standards that cater the unique characteristics of Islamic financial transactions. So the financial accounting standards based on the unique Islamic contracts. Okay. During that time, of course, when we talk about when the universities, in my time is University Islam Malaysia, not many universities offer these subjects. So we have, let's say, that is the main reference. Okay. IFRS, okay, we can argue that IFRS do not have any specific reporting standard for Islamic financial transactions. Okay. Okay, so in that case, if you look at Malaysia, because not yet. Okay. So like the title, for the title, if I mention the title IFRS for AUFI for Islamic financial transaction evidence in Malaysia, of course in Malaysia we already apply IFRS. Okay, we already adopt IFRS, same as many other countries that practice Islamic finance. Okay, so is this the right move? Okay, so we're going to discuss on that, especially when in our case, okay, MSB has concluded that it would be not in conflict to apply IFRS for Islamic financial transactions. Of course, they have a point to note there. Okay, I read the footnotes, okay, in the policy document. Even though, in line with the MSB consultative approach, a licensed person is to refer to MSB, Malaysia Accounting Standard Board, when there is divergence in practices regarding the accounting for a particular Sharia compliant transaction or event, or when there is a doubt about the appropriate accounting treatments. So it's not stopped there. Means that we follow IFRS, but in any case that we think that there is some transactions not really reflects the Sharia compliance, we can go back to MSB. Okay. Not only that, in Bank Negara reporting of financial reporting Islamic financial transaction policy documents, they mention that, okay, first, okay, they state that a licensed person shall comply with Sharia Advisory Council of Bank Negara Malaysia on the applicability of accounting principle adopted in MFRS being consistent with the broader view of Sharia principle. Okay, basically when we want to convert into IFRS, okay, the framework, broader view of the framework is Sharia compliance. Okay, we're going to look further on the principle later on. Okay, I got the opportunity when I did research. Okay, I meet Bank Negara staff. Okay, just for informal conversation. Say basically, yes, they agree with the conceptual framework, but they not really look in details on exact calculation. You know, like how you do the amortization. Okay, that kind of stuff. We not look in that details. So there's a lot of things that need to be improved. Okay, another thing in the policy document, okay, they state to take difference between Islamic banking transactions, okay, versus conventional banking transaction that involve trade-related transaction, partnership-related transaction, profit and loss sharing transaction. In the policy document, they mention if there is a difference, okay, we need to take consideration on that, even though we are applying IFRS. Okay, so is that an issue again? Okay, so for Malaysia experience, okay, basically before actually we apply IFRS, okay, in 2001, okay, MSBI 2001, by view of unique characteristic of Islamic transaction, okay, previously, this is the first stage. The MSB had an initial plan, okay, to develop a separate and stand-alone set of Islamic standard for the reporting of Islamic financial transaction. This is the first step, okay. At first, because of the unique characteristics, we think that, okay, we have to adopt a stand-alone standards. However, the subsequent research, according to MSB, discovered that much of the conventional accounting concept and principle could be applied with additional disclosure to explain the use of Islamic contracts. So they are more emphasized on the additional disclosure because the concept can be used, okay, in general, okay. So after that, okay, in 2009, okay, sorry for this, okay. So the MSB I1 is the presentation of financial statement of Islamic financial was then issued in 2001. However, as I mentioned before, the subsequent research discovered that much of the conventional accounting concept and principle could be applied with additional disclosure to explain the use of Islamic contract. Further to this, with the consultation from the Sharia Advisory Council of Bank Negara Malaysia and the Security Commission of Malaysia, the MSB was ceased its policy of issuing Islamic accounting standard and withdrew FRS I1. Okay, this is MSBI is later it's called FRS I1. Okay. So on 15 September, the MSB issued statement of principle, financial reporting from Islamic perspective to ascertain the MSB approved accounting standard shall apply to Islamic financial transaction unless there is contradiction with Sharia concept and principles. Okay, so that is a very key words. Okay, even though we apply FRS, but they have a we need to, unless it's contradict, we can have a discussion. We can ask IFRS to do something with the standards. Okay. Finally, MFRS, which serve as a basis of financial reporting in Malaysia, have been fully converged with IFRS from 1st January 2012. Okay, so that is basically the I can say the transition period, okay, from Vitra Malaysia plan to have their own standard, and then now they converge into MFRS. Okay, if you look after, so what is unique in Malaysia, especially when Malaysia fully convert to IFRS, which is MFRS, introduction of MSB Islamic Technical Unit. Of course, before that they also have this, but now their responsibility is more. Okay, on Islamic financial transaction include both practitioner, academician, regulator, example Bank Negara Malaysia and Malaysia Accounting Standard Board. Okay, here advise MSB in development and framework relating to Islamic finance, which can be brought up to IFRS. Okay, so we have experience in this before. I was in ISRA before, so we are part of the committee member. So we discuss in outreach event on Islamic financing transactions. Okay, surprisingly, most of the questions is come from IFRS. Okay, they are the one who argue whether this transaction is right or wrong. Okay, so among the discussion, some of the discussion they say, okay, let's say like in panel 2 mention Islamic bank really Islamic. Okay, is because of maybe it looks similar. Okay, so some of the discussion say if it's different, why the accounting treatment is the same. Okay, so and then my teacher about Sharia governance, okay, Sharia audit also will reflect in these discussions. Just now, very informative for investment accounts. Okay, now we are struggling. ISRA have produced a research, and then MSB are still yet to come out with the accounting treatment for investment accounts, whether it's a liability or it's an equity. Still, whatever issue that you discussed earlier, so we'll come back to account for reporting. Okay, so any IFRS issue on Islamic financial transaction just now is part of that issues. Okay, another issues is on effective interest rate. Okay, applying on amortization of financial transactions, especially on financing. Okay, even the IFRS question us, let's say we have murabah financing, we have BBA financing. Is that a financing or trade? So we can ask expert here if it's a trade is under IFRS 15. Okay, different IFRS from IFRS 9, which is financial instruments. So first basis we need to clarify what is this transactions. Is it financing or trading? So this is already also been discussed in the standing committee. Okay, Malaysia experience, they lead AOSG or AOSSG working group on financial reporting relating Islamic finance. Of course, they have many research and publications. Okay, important publication here. Also, this working group facilitate AOSG members by providing input and feedback to IASB on the adequacy of IFRS standard to cater Islamic financial transactions. So before, let's say, when Malaysia, comply with IFRS, okay, we comply with IFRS, but we have take into consideration of whether while we are doing the reportings, if we think any issues, we say we follow 100%. Okay, so the issues, come to the issues. The issues is actually a long time issues. Okay, AOSG in the research paper discussion made on whether a separate set of Islamic accounting is required or IFRS can be applied to Islamic financial transactions. Okay, so basically this is what their suggestions. And then what need to be further investigated is on the concept itself, is on the principle. The acceptability of reflecting a time value of money in reporting Islamic financial transactions. And then another one is on the issues on the conventional approach of recognizing and measuring the economic substance rather than its legal forms. Okay, so this time value of money is much related to when we calculate later on the use of effective interest rate. Okay, even in the discussion, during the discussion with the groups, with the standing committee, so some argue because when we apply effective interest rate, we can apply it similar with effective profit rate. So some argue the profit rate is the subset of interest. Okay, argue to that extent. Okay, and then some argue to the extent that interest definition in IFRS is not riba to that extent. So why I'm really concerned, because I get during the conference in Glasgow, Professor Hudayb, which is expert in Islamic accounting, they mentioned the standard is very important because the standard is like a fatwa actually. Because what in the standard we going to follow, okay, and then all the reportings and then the outcome, the profits, for example, will affect the users of financial statements. So it's like a fatwa. So another issue on the time value of money, a straight line basis for amortization based on our fee. For example, whether if let's say we agree that there is a time value of money, okay, but now how to do it? Is it we want to amortize it using effective profit rate or a straight line basis, which is Sharia compliant maybe, which is fair? Okay, I've discussed with Sharia scholar about these issues. Some is not concrete because it's just a discussion. It says as long as you they're not looking at the justice element as yet. Okay, as long as the profit being allocated depending on which types, it's Sharia compliance. It's not say that this is more Islamic than another treatment. Okay, so we discuss further on the broad view of Sharia principle and accounting principle. Sorry, yeah. Okay. Importantly, okay, this is in the policy document of Bank Negara, SSC of Bank Negara Malaysia on the applicability of the accounting principle adopted in IFRS as being consistent with the broader view of Sharia principle as follow: accrual basis, substance over form, probability, and time value of money. Okay, basically the issues is come on the substance over form and time value of money. Okay, accrual basis and probability been applied in our fee. Okay, substance over form, okay, it's quite okay, if I'm not mistaken, in our fee they not straightly say it's a form. Okay, it's not really clear there. Okay, for time value of money also, it can be applied on the exchange based contract. Okay, I I just clarify a bit on substance over form and time value of money, what in the policy document. Okay. The substance over form, where the form and substance of the transaction must be consistent and shall not contradict one another. In the event of inconsistency between substance and form, the Sharia places greater importance on substance rather than forms. Okay? Okay, most of the times, people, the researcher, okay, the policy, they more concerned on Sharia places greater importance, okay, on substance rather than form. But they forget the first one, okay, where's the problem can be, where's the problem come from, okay, where the form and substance of the transaction must be consistent. That's why not being debated so much, okay, because when the form should reflect the substance. If the form should reflect the substance, so the accounting, whether you use IFRS or you use ALFI, they will, let's say, the result will be the same. I mean, at least how they recognize is the same. Maybe the measurement can be different. Okay, so that's one. Okay, for time value of money, where a transaction involving time deferment, the asset or liability is carried at the present discounted value of the future net cash inflow, outflow, that the transaction is expected to generate in the normal course of business. So the application of time value of money is permissible, okay, only for exchange contract that involve deferred payment, okay, and is strictly prohibited in loan transaction or court. So time value of money can be applied in the, let's say, murabah transaction that have a deferred, or BBA, which is deferred. Okay, so that's some of the issues, okay, that we going to revisit. Okay, so what I do, okay, I managed to interviews few, okay, expert who have teach in accounting for Islamic financial institution, or they have experience. So I just have a few broad themes. First, the theme, the suitably on the use of term Islamic accounting. This one actually I'm not planned to ask, but when I come to say about Islamic accounting, this thing that they say first. Is there anything about Islamic accounting? So some of the interviewers, okay, I just read some opinion where accounting is to be treated as neutral. And there should be no term of conventional accounting or Islamic accounting. Both define accounting as just a process of recording of transaction. Basically, accounting is a process. Okay, but some interviewer mentioned that some scholars use word Islamic accounting by referring to Quranic verse on the obligation of recording of transactions. Okay, some argue on the concepts. Okay, most of the time when you argue about the concept, they relate it as Islamic accountings. So is that account when you prepare the accounts, is it for zakat, for example? So that is different concepts. Okay. So the second theme, the development of Islamic financial transaction reporting in Malaysia. Okay. In this case, they discuss on ALFI, IFRS, and MSB. So some interview mentioned that ISB is aggressively developing a single set of globally accepted accounting standard that can be applied across the business type or model transaction, including Islamic, with full support by international relevant agencies. Okay, this is come from interviews. Group as well as universities that apply IFRS in curriculum. Okay, where ALFI is thriving in developing a set of exclusive standard to Islamic financial transaction in the absence of full support from relevant agency, group, and universities. Okay, this is okay. Presently, the ALFI has become member of consultative group set up by SB to discuss on reporting of Islamic financial transaction. This support readiness the SB to consider the unique issues of Islamic financial transactions. Okay, this is some of the what interview saying. Okay, for instance, the decision on the adopting of standard by the countries has been made with no assessment of which appropriate accounting standard to adopt. As such, there is incident where some countries which declare to adopt IFRS also adopt ALFI over certain transactions. Okay. So, for Malaysia case, okay, one of the interviewer mentioned that where MSB had interested brought the issues and discussed with the ISB, and was then decided to accord IFRS standard after concurrent by SSC of Negara Malaysia, which indicated accounting has nothing to do with Sharia non-compliance. Okay, okay. most of the topic is on the current issues. So where I get the current issues, this will be subject to further research. Okay, I just share you some of the issues and that need to be discussed further. Okay, one of the interviews mentioned that investors are not assured that all reported financial transactions are Sharia compliant, which could affect permissible income, wealth, and zakat. Okay, while the specific issues is discussed in accordance to the application of Sharia contract, standard adoption, and significant difference standard applies. That is also evident by interviews as follow. For example, trade-related financial transaction. For example, murabahah. Just now I mentioned whether it's trading or financings. Okay, and then let's say in our fee they mention it murabahah receivables, but in IFRS they mention it as a financing. You only can know what's the contract by looking at the notes. Okay, in our fee they straight away put a murabahah receivables in the surface of the financial statement position. Another thing on ijarah, for instance. Okay. 2 minutes. Okay. For instance, for ijarah, okay. So is it financing or is it a leasing? Okay. Investment account just now we discussed further. Okay. And then I can say that ISRA have done a research, and then we, with the advice from Sharia committee, it can be recorded as a liabilities, but with additional disclosure. Okay, our fee will argue that because for our fee, it trade investment account of equity of investment account holders, which is separate category from liabilities, and it's not separate category from liabilities and owner's equity. Okay, so that's the issues being brought out. Let's say mudarabah and musyarakah, fair value accountings, okay, adoption of our fee or IFRS. Okay, so finally, I just mention on the suggestion on the future directions. Okay, most of the interviewers mention that we need to improve on the disclosure and also to harmonize of the two standard setters. Okay, in conclusions, okay, so this study provide insights on the issues. It's a very early stage of the studies of the reportings. Inspire Malaysia vast experience dealing with Islamic financial transactions. Further works are needed to solve any issues. Findings show that we have considerable exposure and awareness on the issue addressed. Much work need to be done to harmonize the standard for reporting Islamic financial transaction. The findings have significant contribution to the body of knowledge practice. Finally, for the purpose of financial integration of Asian, Malaysia experience can be learned and the step taken can be followed. Okay, but of course, it's not straightforward steps. Okay, thank you very much.
Thank you very much. We turn now from the Malaysian experience to Indonesia and the issue of sukuk accounting. Dodek, please, we are under strict time limits now, so no more than 20 minutes, okay? Yeah, sure.
Assalamualaikum warahmatullahi wabarakatuh. Very good afternoon. This is an honor for me to present, I think, a simple paper about the accounting sukuk standard in Indonesia. Now, actually, we have already issued the accounting sukuk standard in 2010. Now we have I will present about the revised standard. The outline, the introduction, the development of sukuk standard, and then the relevant issues of, we call it segment of national accounting standard number 110. Actually, in Indonesia, we have a separated standard for the Islamic banks, takaful. We have our own Islamic accounting standard, the conceptual framework from number 101 until 110. Yeah. Now for the convention, now we refer to the IFRS and the research methodology and the analysis. Introduction. Actually, not many countries adopt the accounting standard of AOFE. So far, only 2 countries, the Bahrain and United Arab Emirates, which adopt the AOFE. And then a sukuk accounting standard was issued in Indonesia because IFRS is based on interest rates, which is prohibited in Islamic teaching. So we have issued our own sukuk accounting standard because of IFRS is based on the interest rates. The issue of harmonization between the sukuk accounting standard and IFRS occurs because we have to be recognized globally. If we have different, it become a problem. This paper tries to analyze the revision effect of accounting standard treatment, the fair value and the financial statement of presentation. This is the 2-point issue. And the development of accounting standard in Indonesia, actually, it's the SEC, Securities Commission, has conducted research on Islamic capital market in 2004. They implicitly stated that we have to develop our own Islamic accounting standard in 2004. Then in 2007, the accounting standard was issued. It's also mentioned by Brother Romji. The AUSSG in 2010 researched Islamic accounting and found 2 of 15 issues were identified sukuk accounting. And the sukuk usually refer to market value, and the valuation should not be based on interest rates in Indonesia. And actually, there are four countries which have the sukuk accounting standard: the United Arab Emirates, Indonesia, South Africa, and Syria. They have sukuk accounting standard specifically. Actually, the relevant issues in our accounting standard, the FAS number 110. First, sukuk is based on the business model. This one is similar to the average number 9, so it's okay. Number 2, sukuk is not based on interest rate valuation. Current valuation with requiring rate is prohibited. Is the relevant issue in our the standard. 3, the current value, the discounted value is ignored in implementation, so we have to use other method. At the time is in 2009, we don't have find the method, but I will show you later what the method. Yeah. So before the public hearing of the proposed draft of the sukuk accounting standards, comment were given. First, the gain on the capital income, which is recorded in an income statement before, and B, the different standard which with average is based for the consolidation for the if the parent company is the conventional bank, and 3, the provision of interest rate of valuation. This one the transition requirement. As you can see, this one the before and after. So if before they use the available for sale and then use method fair value, OC mean other comprehensive income. So they have to reclass to the return earning. And then the revision, they have add another statement. If before they report at the fair value to profit and loss, and after they report as fair value to other comprehensive income, so they can report as beginning. No change. So the issue in the revised accounting standard about the fair value income and reclass to profit and loss, and the fair value can be also profit and loss, decreasing value as loss and impairment is smaller. So the research methodology, actually I use the qualitative method with in-depth interview with the selected respondent with the senior accountant in Islamic bank, the managers, and also I analyzed the financial report of the Islamic bank before and after the revision. Yeah, this one before the quality standard, as you can see in the slide. Before the quality standard was issued, the 11 Islamic banks. This one is the full-fledged Islamic bank. Only one bank, the BSM, Bank Syariah Mandiri, which adopt the IFRS, the conventional, but other they don't mention which standard they use. BGB, Bank Jabar Banten, they refer to the Bank Central Bank. So before the quality standard, each Islamic bank they have interpret their own perception which method that they can use. This one the before, and this one the after. After the quality standard was issued, almost all Islamic bank use the quality standard. Only one bank that still refer to the IFRS standard, the conventional, this BCA, Bank Channel Asia. This can be approved because they have to consolidate with the parent company, which is conventional. And another issue about the recognized to loss equity on default sukuk. Only BSM they recognize loss for the default sukuk, but other bank use all the default sukuk, they don't recognize loss for this. And about the after revision. After revision, I used 3 banks, Bank Muamalat, Bank Negara, and Panin Bank. Only Panin Bank is used the revision accounting standard sukuk. As you can see here, that if there is any change in sukuk fair value, it will affect to the other comprehensive income. They also state that they use the discount rate, but when I confirm to the manager of the bank, he said that no, they don't use the discount rate for the impairment. And the difference between the June 2015 and September 2015, they changed the method. They use the contractual cash flow model. Before they use the cash cost and fair value other comprehensive income. Yeah. And this one is the last one is the analysis from the manager of the bank, the comments. The first one is about the classification of the sukuk accounting. So for the revision standard, the classification consists of 2: the cost and fair value. Recorded at fair value which affect other form of other comprehensive income, the OCI. And second, the valuation after beginning recognition, it affect to the OCI, other comprehensive income. And the third, the sukuk investment fair value. Before we have three types of the price of the sukuk. Now for the revision only 2. The quoted and other quoted price is become simple. And fourth, the transaction regulation. So far there is no different effect about the transaction regulation. I think that's all about the presentation for the accounting sukuk in Indonesia. Yeah.
Thank you very much. And now, finally, after a couple of academic presentations, we want to hear a practitioner at work trying to make an Islamic bank conform to IFRS, to International Financial Accounting Standards. Denny Hanafi. Thanks, Denny.
Thanks, Clem. Thanks for the time. I should have told Clem that the accounting topic at the very end of the day is going to be a bit difficult for the audience, but I'll try to get you guys through the next 20 minutes to talk about accounting. It's going to be a bit different twist with the discussion that we've had almost all day long. I think we've heard from policymakers, we've heard from academicians, we've heard from researcher. I think this last one, full disclosure, I'm not an academic and I'm not a researcher and I'm not a policy setter. So once all that policy is in place, then it comes for the bank to actually implement them, and that's where I come in. So I work with the accounting advisory services in Singapore, and we work with companies, Islamic financial institutions and conventional institutions in Brunei, Indonesia, and Malaysia, and a few other countries as well, to basically try to dissect, okay, if we were to adopt this international financial reporting standard, how does that impact us? So my presentation will be most of, call it like a sharing session. So once that policy is out, how did it impact these banks? What behavior did we see? What are some of the comments? So at least we can get a perspective of the impact of these policies, basically. First of all, to all the policymakers in the room, for any changes in regulation that you guys put out, thank you very much. From a consultants, of course, that's how we earn most of our fees. Okay. Throughout all of our projects, in particular when it comes to IFRS adoption, we get to speak to CEOs, we get to speak to Sharia committees, we speak to audit committees, as well as the finance and operations team. And the process of an IFRS adoption, that international accounting standards, can be an arduous, and usually it will take multiple years. On average, when we help an Islamic financial institution adopt the international accounting standards, I would say it'll be about a 2-year project, 2-year period of adoption. So that's the average time period that we work with, basically. So it's a long drawn project. It's a huge change from an operational perspective. And it's a huge change also from how the financial statement will look like, basically, between pre-IFRS, pre-international standards, and post-international accounting standards. But from all these different people, there's probably one cartoon that I want to share that's consistent from maybe the CFO, the CEO, the Sharia committee that we deal with in the operations. They probably say that nobody understands the financial statement. So it grew from maybe 50-page financial statements pre-IFRS, and then by the time they're done with an international accounting standards, it ends up with a 200-page financial statement. If you take a look at an HSBC financial statement, we don't even have to go too far. Maybank financial statements, that's a 400 to 500-page financial statements, basically. That's the immense amount of information that will come out when an entity adopts that international standard. I think throughout numerous discussions that we had earlier, from the policymaker perspective, from the readers, you always say that you want more disclosures, right? But behind those disclosures, there's a group of people who diligently, accountants mostly, try to produce those numbers as a day job, basically. So for every new requirement that the accounting standard comes out, there'll be these work that they need to cover, basically. Okay? So let's talk about that international standard. I think from the earlier two presenters, we had a perspective that there's diversity in perspective, whether that international accounting standards can be applied to an Islamic transaction or a Sharia-based transaction or not. We've heard from Malaysia that their experience is that there should not be any deviation or any major deviation. So MASB concluded that Murabaha, Mudaraba, whatever that, even the whole complex of Islamic financial institution, banking and takaful can apply IFRS standard. I think that position is slightly different from Indonesia. Doriket mentioned earlier, Indonesia, for the most part, adopt IFRS, but when it comes to Sharia-based transaction, they've carved out a specific accounting standard that is catered just for Islamic transaction. Right? And the same goes in many different jurisdictions, so different countries have different perspectives. But what I want to highlight here, basically, that most countries probably have determined that for the sake of consistencies and transparency and comparability among countries, that they've verged on adopting IFRS. So in many countries, including Saudi Arabia, for example, they have plans to adopt full IFRS, which means even Islamic-based transactions will be accounted for under the under IFRS, basically. So if you can see here, I know it's a bit small. Out of 140, I'll take a look at it from here. Out of 140 countries that the ISB, the standard setters, have tabulated, approximately 116 have adopted IFRS, and that includes even countries like around the region, Brunei, Malaysia, Singapore, for example. So it's quite prevalent, this adoption of this international accounting standards, right? More of an anecdote, I do want to highlight the country here that is not adopting IFRS. One of them is the United States. Of course, the US always want to be different from the rest of the world, so they have their own standard that they still stand by with, basically. Yeah. So, is there a huge issue when it comes to adopting that international accounting standard to Islamic financing transactions? There's quite a few, and some of these can be quite arduous for discussion, basically, especially when we start discussing the application of IFRS, in particular, say, to Sharia committee, right? Some of the differences includes how do we recognize financing profit on transactions, say, like Murabaha, the one that our earlier presenter have mentioned earlier. Treatment of on or off balance sheet of investment accounts, treatment of debt versus equity classification of deposits, for example, how to account for lease transaction. There's this contrasting perspective of how you would look at it considering Sharia perspective versus how you would look at it considering an IFRS, which is, you can call it, it's designed largely from a conventional perspective, right? I won't go into too much detail. I'll highlight one differences and I'll walk you through it, and I'll also probably share with you some of the stories that comes about from our past conversion project to illustrate the difficulty and complexity when it comes to practice. Right? I'll pick on the first one. Any examples that I have on the next subsequent slide is not necessarily it's basically a distillation of various issues that we found. It's not representative of a single bank, but the idea is there, basically. The story is intact for almost every bank that we work with. Yeah? So let's take this example. Let me just flip to this slide. So a bank offers a murabaha financing to a customer, let's just say for a house. The financing is 100,000 and profit is 7,000 per year. So total profit that will be charged on this transaction would be 35,000 over 5 years. Right? The customer pays an installment, even amount every year, 27,000 per year. Okay. So let's take a look at this. What would the bank be recognizing year on year? 100,000 is issued to this customer to purchase this house. Right? The first year comes, basically, the customer pays 27,000 in installment. 7,000 is for profit, and 20,000 is to pay down that principal amount, so to speak, and what's left is 80,000. The same goes for the second year, 27,000 installment, what's left is 60,000. Third year, what's left is 40,000. Fourth year is 20,000, and finally, at the end of the fifth year, it's fully paid. So with that, 100,000 of financing have been fully paid down through time, and a profit of 7,000 per year, which is 35,000 over that 5 years profit, has been recorded by the bank. Okay. So this is the perspective how the cash flow works. So every year the customer actually pays 27,000 per year. This is also the perspective of AOF, which is basically it's a straight line recognition of profit. The idea under AOF, highlighting AOF's perspective here, is that this 35,000 is a trade profit. We facilitate a profit, earn 35,000. The duration of the facilitation is 5 years, and if we earn 35,000 over 5 years, then we would have earned, on a straight line basis, 7,000 per year. What's the impact here? Of course, then the bank would have that declining balance sheet that you would see on part of their assets, 80,000, 6,000, 40,000, and they would have a steady profit, 7,000, 7,000, 7,000 over the next 5 years. That's going to be their income statement profile that we expect out of this bank. Okay, so that's basically the AOF perspective, and to a large extent, it's also the contractual perspective. The bank might actually state that the profit rate is 7% in this case. Yeah. I'm going to move on to the next slide. So how does IFRS, that international framework, views this transaction? This is going to be the difficulty of applying from a language perspective, also from how we look at transaction perspective. When we look at IFRS 9, the definition of how to record such financing and arrangement is that it needs to be accounted for under the effective interest method, which basically means if this balance were to accrue interest, to have a discounting effect, to have a time value of money effect, how would this balance behave? I know it's a bit small. There's a comparison between the two. On the left side, we have the straight line AOF method. And on the central here, we have that IFRS effective interest method. We won't go into the calculation. Those of you who are trying to pull calculators to see how it's being calculated, no need to do that. I'll walk you through the concept. So if a customer draws 100,000 at day one, that balance will accrue a certain rate, an interest rate, so to speak, according to IFRS. And then that would be the P&L. And then if the customer pays down that balance, there's a remaining balance, and that remaining balance would then accrue that same rate every year based on remaining outstanding balance, which is the effective interest rate. If we were to calculate this, the effective interest rate is actually 11%, which is, in a way, you can call it the APR, basically, the effective rate of this financing arrangements. Right? So IFRS would say that we would have to recognize it using this APR method, or effective interest rate method. So hence the balance sheet and the P&L for every period is quite different. Right? In any given point in time, the balance sheet is actually higher compared to the IFE effect. And depending on which year, the P&L, if I look at this example, the P&L for the first 2 years is higher under IFRS. And the P&L on the later part of the 2 years, basically later part of the financing arrangement, is actually lower under IFRS. So it's not a straight line method. But in a way, it's a method of allocation that reflects the yield. So meaning if there's a lower balance, we would effectively earn a lower yield on that financing from the bank's perspective. Yeah. So when we were done with one of the calculations, right, and the CEO of one of our client bank heard that we've done up an estimates of the impact for his bank, he emailed me right away, and his main questions basically, Denny, I heard you're done with your calculation on our financial statement impact. How did we do? Did we meet our target? The biggest question that the person running the bank would basically see, are you going to change my profitability? And I hope it means it's a higher profitability if we adopt IFRS. Well, in reality, it will depend on what kind of the composition of the portfolio. And as we learned earlier, on the later part, if the portfolio of the financing is on the older, on more seasoned, we will end up having to adjust their profitability down. On the other hand, if it's on a younger portfolio, it will have an impact where the profitability of that bank upon adoption of IFRS would actually end up being higher. Right? Of course, consequentially, not only it will change whether they've met their budget or not only it will change their P&L and various ratios that will be evaluated, it will also change their balance sheet position. Total asset will change, which basically means any capital ratio that they need to be complying with may also change. So in that bank that we help where it ends up with a lower profitability, I think we were joking, we were probably one of the very few consultants whom by the time we're done with the project, we end up with the client with less profitability and still get paid for it. So. Now, at the end, people work based on incentives and based on KPIs, right? Different departments, retail and consumer financing and corporate financing, they all have their own KPIs. And some of our banks have investors, maybe from a group perspective. We spoke about it. Some of the banks in the regions are actually owned by a bigger group of banks, right? When numbers start to come, profitability change, right? Of course, then there's a huge discussion about what was my KPIs based off? What was our budget that was set by our investors based on? Should have been based on the IFRS number, or should it be based on existing systems, right? For example, what I want to highlight, if you are the head of this department that had expected a steady profit because of your existing portfolio that you're going to run off for the next few years, and you've adopted IFRS in this period, it's not going to be too good for you because you get paid bonus based on this, and the profit that you had expected for your future years is now allocated to prior years, and what you're looking for ahead is basically just less profitability, right? So one of the biggest discussion that we always end up with is how do we budget Can we not stay with our current accounting when it comes to internal reporting? And in a few discussions that we had with our clients where internal management decide, can we keep dual reporting, at least for internal KPI management? They want to stick with the same accounting standard because at least you get that same impact basically from a KPI and evaluation perspective, right? So quite common upon adoption and changes in accounting standard, you have resistance for change that you end up with maintaining two different set of books almost, just to adhere to whatever current culture or existing cultural preferences that we have. I won't go well into too much details here. Of course, that was an example of just one financing, but imagine in a bank, this is just a number that I picked from one of our medium-sized clients that we have. If you have 125,000 financing with years to maturity, 1 to 22 years, that translate in this particular bank to 18 million cash flows that you need to adjust under this table. Unlikely that we were doing in Excel, having an associate doing it one by one, right? It's going to be harder. So the biggest investments to anyone who's thinking about policy of changing accounting standards, that the biggest impact is also on system changes, and that was probably one of the most costly items when it comes to any accounting and financial reporting changes, right? The system that goes with it to be able to calculate all these balances, basically. Okay. But I think the one that I want to highlight more specifically in terms of implications from a practical perspective, I'm going to pick the year 3 as an example here. So the same table from what we had earlier, but if you just look at if we were in year 3. Okay. If we look at the balance sheet of this single customer, single financing, under the existing straight line or AOA fee-based calculation, the customer owes the bank $40,000. Under IFRS, though, that number has been recalculated that the balance is $46,290. Number one question that our client asked us, so which one do we report to our customer? We've been sending them statements of 40,000. We cannot possibly suddenly say to them, actually, we changed accounting standard. Now you owe us 46,000 instead of 40,000, right? So that's the first issue that they found. Of course, it comes to the discussion that I think our two presenters have mentioned. There will be differences between legal and accounting. In most cases, we'll probably revert to whatever you have been reporting to your customers, which is if it's 40,000, then you can continue with that. But of course, then you'll have discrepancies between how the bank look at their performance and what balance do they own versus what they actually communicate to their customers, which raise another issue, which is basically which one is then the true balance. If IFRS says the customers owes us 46,290, but straight line method says that the customers owes us 40,000, which one is correct? Which one, of course, the number one question will be honored in a bankruptcy court. So are we going to go to a bankruptcy court and say, well, we're following IFRS because it's a higher number, but the customer owes us 46,000 actually? Or is it going to be the 40,000, basically? It's another, I guess, perspective that comes with that. Next one is, how about for regulatory perspective? Because the balance sheet between a straight line or AOP based versus balance sheet of an IFRS based can be substantially different. So when a bank reports to their central bank, which one would be that balance sheet? Which one would be that retained earnings or equity or liability, right? And which one will be the one that capital will be imposed on? Right. One more thing that is going to be problematic is IFRS prescribe continual accrual of interest, so to speak. But in reality, when it comes to Islamic financial contract, if there's a delay in payment, technically under IFRS, you would still continue to compound interest because that's the effective rate that needs to be charged. But it is quite different from conventional loan contract because if there's a delay in payment, technically under conventional, you may continue to charge the applicable interest rate. Of course, under conventional, you may charge a penalty, but there's not really a continual compounding for outstanding balance, which will result with a little bit of complexity. So that means every time there's a delay in payment, the accounting system may continually compound as an additional interest, but then you would have to write them off right away because you're not actually going to earn it. You're not actually going to collect it from your customers. The last one I want to share is when we spoke about this to various Sharia committees of our clients, the biggest issue is the Sharia board will still have to sign off that we have been compliant as a bank. But if we were to report a financial statement, which is part of the bank, and that financial statement has time value element, have discounting element, can we still say that we are Sharia compliant? And I guess that's the difference perspective between the Malaysia and Indonesia, for example, right? Different result on their perspective between the two countries. That's on existing accounting standard. Fast forward, just quick information on this one. In 2018, of course, ISB decided to have a completely new accounting standard. And that new accounting standard that all banks that will be applying actually have definitions for certain accounting treatment that the transaction is qualifying financial instruments for cost accounting only if it pays solely principal and interest consists of time value of money. So I think what I want to highlight, going even standards under IFRS is drafted using such language. If we were to help clients later on 2018 or prior to 2018 to adopt this standard, from a practitioner's perspective, I would say that I will have a hard time talking to these Sharia committee to say that, no, you comply with this. And this language actually said, wait a minute, but this standard says that to comply to this, we would have to charge time value of money. So I think from a practitioner's perspective, I'm not going to put my vote whether there needs to be a separate accounting standard for Islamic bank or there should be consistency, right? There's pros and cons on both sides, right? We cannot deny the benefit of having Islamic financial institution being on the same playing field with conventional conventional banks when it comes to financial statements, so that they're evaluated by credit agencies on an even basis, right? There's definitely benefit for transparency. There's definitely benefit for comparability and consistency, right? But at the same time, there will be practical difficulties if you decide on that path, that basically applying a standard that's technically not designed for an Islamic finance into an Islamic financial product. I commend the Malaysians' effort to basically be at the forefront. I think what is needed is a greater representation on the ISB, making sure that the voice of the Islamic institution is actually being heard, that the standard is drafted in mind with it is the Islamic financial industry. It's a huge industry, and I think the accounting standard would actually need to listen to it to make sure that future accounting standard is a bit less arduous to apply when it comes to Islamic banks. That's all I have for today. Thank you.